I'll start. Oh, we are live. There we go. Hey, Todd.
Hey, Jon.
And hey, everyone who's joining us now on the webinar. Todd and I are very excited to talk to you all about some red flags in financial reporting. So I'll go ahead and share my screen here, tell you a little bit about Todd and I, and then we'll get into this thing. So since you're going to be spending the next 30 45 minutes, maybe a little bit longer with us, if the Q&A is really rolling in, we'll tell you a little bit about ourselves. My name is Jon Cochrane. I'm our GM of payments and partners here at Maxio. I'm actually a CPA by trade, so came up through public accounting, then worked for a few different SaaS companies before ultimately joining Maxio. And I'm joined by a friend of the company here, Todd Gardner, managing director over at SaaSonomics. Todd, maybe just tell everybody a little bit more about yourself.
Sure. Mostly finance background. I was in venture for 10 years, right when SaaS was getting going. And then I spun out and launched my own firm called SaaS Capital. I ran that for 13 years, sold it in 2020. And that's really what informs this conversation at SaaS Capital. I had the chance to look at thousands, literally, of SaaS company financial statements. And so it's that perspective that I bring here today.
I love every time that you and I chat, Todd. I love hearing your perspective on just, it's rare sometimes for people to hear from somebody with your pedigree and background who's kind of been there, done that, and seen it. And I think it'll be fun too. I get to maybe relive some of my war stories here from the red flags I was trying to resolve back when I was a practitioner and a controller. So we'll jump into the agenda here. What we're going to cover basically is, what are some of the red flags? Todd wrote an article a few weeks ago discussing these, like what are the things that you have to look out for when it comes to your financial reporting. We'll ask you all a few poll questions, and then we'll talk and go through why they matter, advice, and then some takeaways for all of you. So I'm not going to keep my screen up the whole time, but one thing just to get the conversation going, Todd, just want to ask you, your post about red flags in financial reporting. Maybe tell us a little bit more about like what it was and why you wrote it.
Yeah, we were talking a little bit off screen.
Yeah.
So I continue to work with SaaS companies today. I mostly help them in fundraising or M&A, but I thought most of these issues would have gone away by now, having looked at SaaS financial statements for the last 15 years, and they haven't. And it's because new SaaS companies, start up all the time, and there's new people running them and bringing their own ideas to the table. So it was an effort to help folks avoid pitfalls. It's really not necessarily a comprehensive list, but it's the kind of things that, like, hey, just avoid doing this and your life will be a lot easier and you'll be a lot more successful, primarily in a fundraising or M&A transaction, but also just in running the SaaS company day to day and generating metrics and things like that.
When I was reading the article, Todd, there was, when we were chatting a few days ago, you had this there was a part of me, I was reading your article and I went, somebody finally sees me. As a controller at, a SaaS company, I always felt like I was just locked in the back office when nobody really cared about what I was doing unless I missed payroll or my numbers were wrong. Right. But it was so challenging to get the numbers right. And it was kind of just this thing that unless you were in the weeds doing the numbers around the finance team, you didn't have an appreciation for how important they were. And I know we'll get into some of those war stories here, but we I think you had a different post, Todd, called "Revenge of the Bean Counters" back in the day.
One of my more popular ones, yeah. Because it helps guys like you go, yay, yeah.
Yeah. Well, this former bean counter, I feel like you went bean counter once, bean counter for life. I feel like I'll never be able to get away from it. It's just a lot of good principles there. But one of the things that you talk about in your post, and I'll share my screen here again, is that a lot of this stuff starts with bank reconciliations and cash is king. And so back to you, Todd. I mean, why do we kind of start with bank reconciliations, cash is king from like your perspective at SaaS Capital and even what you're seeing today?
So I learned this the hard way, to be honest. I'm a finance guy. I didn't really know what a cash reconciliation was until a couple of portfolio companies I was working with, and this is back when I was in venture, not at SaaS Capital. The CEO and controller had just gotten out of doing cash reconciliations on a regular basis. It led to, fundamentally inaccurate financial statements. So revenue was overstated, cash was overstated. And at the end of the day, when they went back and did the reconciliations and we had the board meeting and, the shit hit the fan, both those companies failed. And it wasn't necessarily because the numbers were wrong, but that was a big contributing factor. So this is just a reminder that fundamental hygiene is incredibly important. Once you've lost, the confidence of your board and your investors in the numbers, like all bets are off, right? Like we're financial people, right? That's the language that we speak. If we can't trust the numbers, we can't invest in the business. So those companies went under not only because they couldn't raise new capital, they couldn't raise capital from the existing investors because we're just like, we don't know if these numbers are real or not. So it just reemphasizes and elevates the importance of getting numbers right. And in my opinion, bank reconciliations is a really key way to do that because you're tying your numbers to something real in the outside world. It's one of the things that allows, two-entry accounting systems to work, right? Is you're tying it back to something that makes sense. And if you don't, you can get off track.
It's yeah, I'm already starting to feel a little nervous from the just some of the pressure around getting the numbers right. So, I rewind my career a little bit. And I remember when I, got my first controller job, I was coming into the business. I was pumped because to that point in my career, I'd spent, most of my time doing the grunt work, bank reconciliations. I was wicked on, I would go to these, when I was in public accounting, I could go over to these fancy giant copier machines. Now you can just use your phone, take photos on like, Adobe PDF scan. Back then I was pretty mean on like the 9-key on a printer because I was the one who had to like get the documents, undo the staple and like put it through the machine and email it off to like the partner or senior manager who was going to review all my work. But I was excited to have a controller job because I was like, finally, I don't have to do the grunt work anymore. And sure enough, I came into the business and our bank reconciliations weren't done. And so I spent the next 3 months printing out all the bank statements and I would just go transaction by transaction. And I was like, let me check this off. Let me check that off. Let me find this missing transaction. Let me find that missing transaction. Because to your point, if you don't have your bank reconciliations buttoned up, like you, at some point, you might not catch it in month 1, month 2, maybe even for a year or 2 years, but eventually your billings, like your revenue is going to be off and your ARR is going to be off and something is not going to reconcile between what's going on in the bank and what's going on in like your top line metrics, which is what all the investors, that's what everybody wants to talk about. They want to talk about top line, et cetera.
It's the bedrock, right? That's why we started here. It's just like, and hopefully this is not an issue for anybody and this is old news, but like you can't not do it.
Yeah. Maybe to get into some of the, just some of the nuances of financials and presentations. You also talk a little bit here about cash accounting. Like we talked about cash, bank reconciliations. Okay. Let's assume I've got that all figured out, but there's also, this thing called accrual accounting. And you had talked about how, these can be confusing and, but they're different, they're related, but very different. Maybe, walk us through a little bit about how mixing up cash and accrual accounting can just be a recipe for confusion.
Yeah, it was always in like probably the first call with a prospect. I'd be like, "Hey, tell me about your company and blah blah blah," and it'd start rattling off some metrics. And I'm like, "Are you using cash or accrual accounting?" So, and the worst answer is, "Well, some of both," right? And I'm like, "Oh no." Always the worst answer. So
I'm laughing out of pain.
yeah.
So not what you want to say.
Cash accounting is fine, right? It's simple. It's easy to reconcile. It works up to a point. It's hard to do metrics, and I'll talk about reasons why you need to move away from it eventually. But it's okay, and investors in early stage SaaS companies are kind of used to seeing cash accounting. So don't feel like you have to like come up with some ad hoc rev rec to meet investor demand. When you do transition, you need to like fully transition. You can't dabble in, and I'm talking mostly about revenue recognition here, not necessarily the expense side.
Right.
Investors tend to care less about that, but you can't dabble in, well, we do it sometimes. We do it on large contracts, or we do it on an ad hoc basis every once in a while. That doesn't work. It leads to tremendous confusion in usually a pretty meaningful way around the number that investors care about most, which is revenue. And I thought this issue had primarily gone away until I did a fundraise about 3 months ago, where a company was using a mix of accrual and cash on rev rec. Their numbers looked good at a high level. We got 3 term sheets and picked one of them, and then we dug in, and everybody got confused as to like, where's this revenue coming from, and how'd you get there, and how come you're profitable but your cash balance is going down every month? Legitimate due diligence questions that were brought about by just really confusing rev rec. So stick with cash until you need to move on. And my recommendation is like $3 million. But once you do, you have to do it in a clean and accurate way.
Yeah. For those of you on the by the way, I should have said this at the beginning of the webinar. If you have questions that you would want to ask either myself or Todd, or things that are piquing your interest that you want us to double click on, go ahead and post a question in the chat. We're happy to take those as they come in. So
or comments.
Feel free to, or comments. Yeah, exactly. But for those of you who are like, well, cash accrual, what is it? If I'm explaining this to somebody, the way I like to explain it is, if you have, say, a $12,000 contract with a customer, right, and you get it in the bank in January, cash accounting would say, great, I got $12,000. I'm reconciling my bank account. You're already on the right track if you're reconciling your bank account. And then you go and you record that to revenue as $12,000 in January. Accrual accounting is, well, that $12,000 you got, what term is it for? So if that would be for a year, you only get to recognize $1,000 in January. And then you have to spread it out each, $1,000 each month over the rest of the year. To Todd's point, you can't really mix the two. Like, it's cash accounting gets you by early on because, you're just trying to keep the lights on. But once you really get to the next level and you're going for due diligence or a fundraise, you got to make the full cut over and do it for everything. And also to Todd's, Todd, I remember when I started my career as an auditor, that all it took was, we would go into companies and we would call it a representative sample selection of, somebody's data. So you have 100 contracts. We're going to pick 10. We're going to review and see, did you account for them right? Yep. All it takes is us to find one example of something that's not recorded correctly. And then we're going to ask for like another 20. And it's the same thing in due diligence. The moment that you find, it's like the little piece of yarn. Once you find one thing that doesn't make sense, you just pull on that thread and you keep pulling until you get to the end and everybody has confidence over what's going on here.
So our at SaaS Capital, our diligence, our accounting and finance diligence was primarily around looking at contracts, tying those to revenue and then tying those to cash. We did very little around the expense side of the equation. So it's really critical. And it's important the other reason why you want to transition to accrual is all the metrics are driven around accrual accounting. You can't really do a CAC ratio or even a decent retention report without moving to accrual revenue recognition.
Now, this kind of gets into, we're starting with cash and we're talking about cash to accrual. And then you just, teased on kind of our next subject here, which is, financial statements and kind of starting to tie it all together. So we do have a question for the audience here. And this is, around how often does your team actually reconcile your financial statements? And when we're saying, how often does your team reconcile your financial statements, we're talking about your P&L, i.e. your income statement, balance sheet, and cash flow. Those are like the big three when we're talking about your core financial statements. So we'll go ahead, cue that poll. And then if you could answer that, we'll revisit that. But Todd,
is the question, how often do you do bank reconciliations or what?
Oh, how often does your team reconcile your financial statements? Okay. Whoops, sorry if I said bank reconciliations. Yeah. So how often does your team reconcile your financial statements?
Cool.
P&L, balance sheet, cash flow. And then Todd, maybe you were mentioning that you had a standard, you all have a standard process whenever you were evaluating deals related to tying these all together. Could you just walk us through, when you're going through a due diligence round, like what is that process? What are you looking to do? And what are the most important parts of that reconciliation?
So from a financial statements perspective, and we'll get into retention in a little bit, which is obviously a very important piece of the pie, but from the financial statement point of view, I was surprised by, the number of folks who couldn't generate a connected P&L and cash flow and balance sheet. They'd be like, oh yeah, now I got the P&L for the last 12 months. I have a most recent balance sheet. But if you ask for, well, no, give me a quarter's worth of P&L, income statement, and balance sheet for the exact same period, because as we all know, those financial statements work very closely together. And so it's a sign of, well, it's interesting. The people who could usually generate that were either companies with super simple businesses, right, who were doing cash accounting and weren't off manipulating things in spreadsheets. The other people who could do it were relatively sophisticated firms with, CFOs and folks that have been around the SaaS business a long time. But a lot of folks couldn't generate that connected three-way P&L, cash flow, and income statement. And I would further say the cash flow piece of that is maybe the most underutilized, financial report in SaaS. If you are dealing with businesses that are collecting annual in advance, Jon, like you mentioned, maybe they have a small number of large contracts, for example. They might have seasonality, and if they're doing anything that's in advance, the cash flow of that business looks very different than their P&L. The P&L is perfectly smooth. They're either making this amount of money or losing this amount of money. But in reality, cash flows are, gyrating pretty dramatically. Controllers know this. CFOs know this. Some CEOs know that. A lot of investors don't really understand beneath the weeds there that cash and a lot of these SaaS companies that aren't collecting monthly, there are very big gyrations in cash flows that can have a significant impact on the business. Like you can have a profitable SaaS company that runs out of cash. It happens, all the time. So that's an important reason to be able to connect those three, and re-emphasis on the importance of the cash flow statement in SaaS. That actually took me a long time to learn, but again, you can have very profitable SaaS companies that run out of cash because they're consuming deferred revenue, and not adding more bookings.
It's interesting. In talking to our CFO, working under a few CFOs, I spoke with, I actually asked a question to CJ Gustafson a while ago, and a lot of it was around, what's one of the most important things for a CFO to get right, and everybody in their top three says cash. There aren't a lot of, everybody makes mistakes. There's some things where you got to clean up the numbers a little bit, but kind of the one unforgivable thing is a business running out of cash, especially if you're a CFO, and it's running out of cash like as a surprise that you're running out of cash. Like you got to be able to see that early. If you can reliably predict revenue, then you have a good revenue ARR, and then you have a good handle over your expenses. You can pretty much see, I'm going to have this much cash in January, February, March, whatever it is, and forecast it out. And so a good CFO will be able to, or a good operator, whatever it is, you might be outsourcing your books. You can see that and you can predict it. The thing that'll get you fired probably quicker than anything else as a CFO is if you surprise everybody and say, whoops, we're going to be out of cash in next month. And I think the thing that people don't always appreciate with these, you just said, there are plenty of profitable SaaS businesses that run out of cash and they have to close up shop. And so you could be, I don't know, $20, $50 million business. And you're like, wow, that's a lot of top line ARR. But people don't realize that it's like a vacuum almost. Cash in goes immediately cash out to pay for your employees, different things like that. And you could be running a margin where you only have maybe $1 million of cash in the bank, depending on how lean you're running that team. And look no further than the SVB crisis. Rewind a little bit here. When all of a sudden, like, cash was shut off to all of these SaaS businesses, everybody was freaking out because they knew if my bank account is closed, I can't make payroll within 2 weeks or 4 weeks, whatever your cycle is. It's like a terribly scary time period.
I absolutely agree. It's exacerbated when you've got large contracts from relatively few customers, right?
Oh,
so
yeah.
Your cash flow is very different than your revenue, right? And so a lot of investors and maybe even other managers won't pick up on the nuances of that and how you can still run out of cash, even though the P&L is clicking along just fine. One thing I always, or not always did, but came to do over time, especially some companies are like, yeah, we're EBITDA break even. I'm like, okay, well, let me just graph cash by month over the last 2 years, right? And of course, it's like down and to the right? So, because one, certain things in EBITDA are actually paid in cash, like interest and taxes. Not many of these companies were paying taxes, but many were paying interest. And then two, there's just cash demands on the business that don't show up on the expense side, right? So the two don't always relate. So graphing cash is just a great exercise to sort of reality check on the P&L and what's the business. And there might be capital expenditure in that business. They might be repaying debt. There's other things that impact cash flow that don't show up on the P&L. That you just need to be highly sensitive to. They do show up on the cash flow statement, which is why I emphasized it so much.
Well, we've spent, about 20 minutes now talking about some of the stuff that, at least in my experience as a controller, nobody could care less about. They were all about, what's the top line, Jon? How much is the company growing? So we're at the point in the webinar where we're going to shift and go from some of the cash, the fundamental things, and we're going to shift to everybody's favorite topic in SaaS and subscriptions, MRR, ARR, the top line metrics. And so another polling question. Oh, and to close out the prior one. Well, anyway, here's our polling question. Does your reported MRR or ARR always reconcile with your financial statements? While we're waiting for that to close off the prior poll, over 90% of you said that you're reconciling your financials on a monthly basis, which is A+, gold star if you're doing that on a monthly basis. So you might not need to do that if you're early enough in the life cycle of your business, but monthly is the best practice there. So while we're while we're waiting for that, I will go ahead and dive into, Todd, I think you dubbed this as separate MRR reports, or kind of when what you're reporting in MRR doesn't always line up with some of the GAAP stuff, whatever that GAAP in IFRS and the regulated reporting methods are. But maybe walk through what are some of the things that you had looked at when it came to MRR versus revenue, and maybe even, well, I'm assuming everybody knows what the difference is, but just to make sure that we don't assume, maybe explain to everybody here, what is the difference between MRR versus monthly revenue?
It's funny. I work on the what's it called, the SaaS metrics board, where we were trying to come up with sort of industry-wide definitions of metrics. It was amazing. ARR and MRR, as basic as you would think they are, took a tremendous amount of discussion. MRR is obviously monthly revenue, recurring revenue, and ARR is annual recurring revenue. The best, well, I will say this: some companies who sell annual contracts think and report in terms of ARR. I booked a $10,000 deal. That's a $10,000 annual contract value. That's $10,000 in ARR. Other companies think almost strictly in terms of monthly recurring revenue, especially if they're monthly bill or even annual bill. The two fit together nicely. The cleanest definition for ARR is actually not summing up your contract value, but simply multiplying your most recent MRR times 12 will get you to the most defensible number for your annual recurring revenue. Maybe not your largest, and that's where the delta comes in. Again, emphasizing that investors and buyers care more about revenue than 3 times more about revenue than anything else. You can't be quoting MRR and ARR numbers out of Salesforce that don't connect to your financial statements. You're like, oh, look, your revenue, your recurring revenue on the financial statement is $1 million, but you say it's $1.1 million. By the way, in terms of valuation, that's a pretty big difference, right? If you multiply that by 12 and then multiply it by your multiple of 6 or 10 or whatever. So even little differences have this huge impact on folks, and they'll want you to connect those two. Our best practice was always like, forget about the separate reports. We're working off what's on the financial statements. That might be a little conservative because on the financial statements, sometimes you're deducting, allowances or things that really should be included in MRR. But we're starting with, a number that gets reconciled monthly, gets tied to cash, gets audited annually, and it's not this thing, out of no offense to Salesforce, but like there's no audit on your CRM, and they don't tie it to a bank account, and so the disconnect between these two can cause serious ramifications. And I know, Jon, you had. I was pleased that you had this same problem. So I'm like, it's just not me.
Oh yeah, yeah. It's funny, Todd. I thought you were whenever you're saying you can't report MRR out of Salesforce, but then you qualified it. You said unless it's tied to the financials. I liked to, when I was back in the operator role, I like to be like, MRR never comes out of Salesforce ever.
Yeah.
It's just like a rule. And we always sales, in finance, anybody who's on a finance team loves to grumble about how sales reports their numbers versus like if finance's number. And there's like always a difference between the two, because, somewhere buried in some contract, there's something that needs to be accounted for in a way that doesn't necessarily translate nicely into MRR or ARR. But my call it blood, sweat, and tears around MRR, ARR was, rewind, a few years here. Again, I was, responsible for reporting out not only our GAAP metrics, but our SaaS metrics. And one thing that we had thousands of customers that were billed on a monthly basis, some with like predictable contracts, some with usage-based contracts. And what we had to do going into the next month was we had to provide a forecast as to what our future revenues were going to be. So we did what you said you're supposed to do, Todd. Take your MRR, multiply it by 12, add in the effect of like whatever, new business you might work in there. That should be your revenue for the next month. And if it's not that, you need to explain what is causing the variance between those two. And we, like many other businesses, had a very challenging time reconciling the difference between what we were predicting revenue to be and what it actually was, and providing an explanation across, from like what our forecast was to what our actuals were. I will spare everybody all the details, but what it ultimately took for us to get this thing reconciled was we basically put, we would close the books, and then everybody on the finance team. It's rare that I've ever done it. Normally on a finance team or an accounting team, you have people who do AP, expenses, whatever. We had a special project where we had a scoreboard, and we said, we have, 2,000 contracts to reconcile. And I had a spreadsheet which had by customer, contract, and item, what the estimated MRR was for the month, or what our estimated revenue was, and what the actual revenue was. And we went down the spreadsheet, probably 20,000 lines long, and we had to reconcile that every single month until we got our hands around what is going on between these two differences. And ultimately it boiled down to, we had done like a system implementation at the time, only gotten halfway through it, and then did 4 acquisitions, and that took over, the busy time of the company, and we just were drowning in here. But the reason we knew that there was a problem was that, Todd, I know you have a little stat here around, NRR is 118%, bookings are strong, but revenue growth is only 20%. Now, these aren't, my old employer's actual numbers here, but we had a trend like this going on where we would report out one number, but it wasn't quite reconciling to what was going on a different number that's related, but not directly, you could tell that something was off. So maybe if you could elaborate a little bit more around, these diverging metrics, and I think you were saying, you're shocked that you still see this as often as you do these days.
Yeah, that bullet point there is I think a great quick sanity check that operators can use, and investors too. Like, hey, is this story making sense, right? And some of this might be accounting related. Sometimes it's definitional. Like, there is no unified way to measure NRR. I wish there were, but even in the public markets, they all report it differently. So cases, you'll get situations where companies are counting upsells as bookings and including it in expansion revenue. So anyway, this is also just a way to it's similar to trending cash and see if that makes sense compared to what the P&L is saying. This is like, hey, this company should be growing 18% year over year without any new bookings, right? But it's booked $10 million. Why these things aren't adding up? And it's important to look at all of them.
So really interesting here on the poll. So everybody here is, reconciling their statements on a monthly basis, or most people are over 90%. But when it comes to MRR, ARR, it's split a third, where a third of you are saying my MRR, it's on lock, perfectly aligned. A third of you are saying it's sometimes aligned, but it takes a lot of work. And a few of you are saying we track MRR separately from what's going on in our financials. Now, could be fine, but got to make sure, at some point, got to make sure that those two are telling the same story. Really interesting stats there. And I think that goes into, or alludes to how challenging this can be. One, jumping kind of to the next topic that we have here, Todd, you get into a little bit around the backbone of financial hygiene, and how you can, what are some practical things that you can start doing to have, some practical ways that you can go about having good financial hygiene. So I'll jump into that here a little bit and pass it to you.
Yeah, this is just my experience, but and I know, thanks to Maxio for hosting this, and they're a tool provider. We did have lots of our companies use Maxio, SaaSonomics at the time, in the early days. And we were always glad when that was there, because it meant they weren't doing revenue recognition, which was primarily the first lead product of Maxio. It meant they weren't doing it on a spreadsheet where you could get tremendous errors, right? But by and large, experienced people trumped great tools every time. Like if you had an experienced, maybe part-time CFO, or somebody who had just done 2 or 3 SaaS companies before, they have ideas, they have systems, they know how things fit together. That was always better than some inexperienced folks. I don't know what it was, but I ran into 3 cases where a young SaaS company, less than 10 million in ARR, had implemented NetSuite. There's no knock on NetSuite, but those companies should not have been using NetSuite. They were just too small. And I think they implemented it because to make up for a lack of sophistication around knowing how to do financials in SaaS. And it was the worst financials ever were generated by those companies. So going back to, experienced SaaS people trump the tools. At the end of the day, it takes both, especially as you scale. But it's also cheaper, just like an experienced lawyer knows what questions to ask and how to draft a document really efficiently, even if their per hour rate is higher. I see the same thing in SaaS finance folks. Like a couple of good SaaS finance folks can run very large, organizations efficiently. Anyway, so that's my bias. That's my experience over the years.
I think, what is it? I remember, I think that's just, I guess I'll just build on that and say yes to all of that.
Yes, it takes smart people like me.
It takes people like Todd to get this right. I think
me. I wouldn't know how to start. Yeah.
But it is really hard to keep this thing going. And when, going back to your point there, Todd, about sometimes you try to, you want to be able to say, hey, I'm not using a spreadsheet to do these things. Sometimes you can make your situation worse if you put in the wrong tool, because then all of a sudden you spend all this time and energy and effort to put in a certain tool. That can be very, very, half the time, once you if you implement kind of this sophisticated tool, it can be really hard to figure out, why is the tool doing what it's doing? And then I need to have certain technical expertise around the tool to be able to troubleshoot it. If any of you on this webinar, we're going to talk about some tactical takeaways here, but I'm going to kind of throw one in early here. There are many great fractional firms out there, or advisors who, to Todd's point, worth their weight in gold, thinking about spending $5,000-$10,000 a month, whatever it might be, for a period of time to get these things right at the beginning, saves you tremendous amounts of money down the road. And that's maybe a good pivot here, Todd, to one of our final topics here, which is why these red flags matter so much. So I know we've talked a lot about what they are, difference between MRR, diverging financials, but at the end of the day, when we think about, okay, why does all this matter? From your standpoint, Todd, it'd be good to just hear, why do they matter from your investor perspective and getting to that next stage of growth?
Yeah. When we first were chatting about this, you were like, if your numbers are wrong, the investors are going to want a discounted valuation. That might happen sometimes, but in most cases, they'll just walk away, right? It's like, hey, I've got plenty of things to invest in or buy, right? I don't trust these numbers. I'm not interested, right? So it almost always results in a failed process. If at some point in diligence, there's a discovery of, oh, this isn't what we thought it was, or this number isn't right. Future processes are also at risk. If that was a Series A and it didn't work, you can't grow out of that. You can't go back to that investor group and say, oh, our numbers are right now. Please come take a look again. It just doesn't work that way. You as a company And in some cases, unfortunately, as individuals, we'll have that mark that can carry with you for a long time, right? There are, I hate to say it, but there are folks that I won't back, right? I wouldn't fund a business that they're involved in because of their past history with financial statements that weren't tidy and accurate and clean. Not fraudulent. Obviously, if it was fraudulent, we wouldn't deal with them either. And that may be unfair to them, but it's the reality. So the downside of getting it wrong is goes beyond the immediate thing that you're working on in front of you, which, by the way, is, if it's a fundraise, can spell life or death to the company to begin with, let alone the future implications.
That's true. Yeah. I mean, I didn't even think about, sometimes you don't have unlimited time to get these funds together. You only have, say, a 6, 9, 12-month runway. I mean, that's like a heavy.
Maybe that was a little heavy. I don't know, but
no,
it is true. We all have these biases in our heads, right? And we're gonna be like, yeah, I remember last time, and it was a nightmare trying to get the right numbers out of that company, those people. Like, I'm just, life's too short.
I kind of paused there, Todd, and I went, whew, because I'm having a flashback to when, I going back to that same example I was talking about, where we had the whole finance team on board, where we were like, we have got to get our numbers figured out. And I remember my CFO at the time walking over to where I was sitting at the time and just kind of had this moment and went, if we can't figure this out within the next month or two, like, we will not have jobs. Because now, it wasn't like we were a good finance team. Like, we were not that bad. This was it was a really challenging situation that we were in. And we just there was a lot going on. I mean, you think about growing rapidly, doing 4 acquisitions, trying to get this all together. But also at the time, I was a first-time controller. So I had not been through these rounds a few times right now. And so I just remember the stakes feeling so high, because it was one of those things where there's no patience. Like, you either figure it out or get out. And, even thinking about those first impressions, and you might not get a second chance with the investor. I go back to, it's like trying to date somebody, where you're like, you get a first impression, and you might be able to go on a second date, or you might not be able to go on a second date, but it's like one and done. And I think that's where, like, it can get real with these, getting these numbers right. One of the, not to put everybody here on the spot, but for our final polling question, before we get into, some advice that Todd can send our way here. We want to put up a question to the audience and just say, if you had to provide financials for a fundraising round tomorrow, how confident are you that they would pass due diligence? So while that's going on,
it would be a nightmare. Yeah. Like that.
I mean, gearing up for due diligence, sometimes you do bring in, you bring in extra help to get ready for it. Todd, on that, you've got a couple pieces of advice for people here when it comes to, like, due diligence meetings and what to think about when you're going through due diligence. And so I want to throw that up here and maybe just have you talk a little bit about, what you should be thinking about when it comes to due diligence.
Yeah.
And this could be fundraising, audits, whatever, a lot of these things are very similar, but more from,
Yeah, this is mostly from a M&A or fundraising perspective, but there's, again, in my experience, and this is talking to thousands of SaaS companies, maybe different for other people, but there's a high correlation between CEOs who knew their company's metrics well, and the performance of those companies, which was generally good, and the CEOs who are like, oh, I don't worry about metrics. That's the finance department. They might know some high-level stuff, but really can't answer questions. When you go to, if you're a CEO, or you might be a CEO on the webinar, but know your metrics. Those are the things that investors, that is how they compare you. That's their benchmark. That's what they know. If you can't speak eloquently about your metrics, they're going to think you don't know your business well. And I actually think that's probably true to some degree. So anyway, coach up your CEOs around all the different metrics and do a deep dive on retention. And this is both for the CFO, finance team, CEO, customer success. Investors will spend just a tremendous amount of time on retention. They like upside, but they fear downside, and retention tells them what the downside is. So you need to know trends, you need to know net, you need to know gross, you need to have done cohort analysis, and why people are churning. Again, that's going to be an area where, and I've seen this having taken companies through private equity processes. If you think about it, it ratchets up as you go later in the life cycle, because more of the revenue they're buying is from the prior year. If you're a startup, a lot of the revenue is just going to get booked in the future, and they're buying into a story. But for an established business, it's all about retention. And if they get the retention assumptions wrong, they could lose a lot of money on a transaction. The other thing I would say, and final thought here, and again, having just taken a bunch of folks through these processes, try not to oversell on the projections. A more modest projection that you can get a buyer or an investor to buy into is worth a lot more than a very aggressive assumption that you have no hope of convincing, somebody will likely to happen. So you need to have a story, you need to have something that's reasonable, and you need to be able to tie it back to some data. And those are the things that really will drive a higher valuation. Again, whether it's an M&A transaction or a minority fundraise.
We had one comment from Lyle here in the chat, and he was saying, these metrics that we have up here, you should be publishing these metrics monthly and make sure that your management team understands them. And I think that's great advice. That was one thing that when we were, when I was responsible for preparing our financials on a monthly basis, I tried to treat them as much was appropriate given the time constraints that we had and the speed to get up metrics that was appropriate. I tried to treat those as though they were an annual close, or at least have the core financials in a state where we weren't having to do all this extra work at year end versus what we were doing on a monthly basis. Now that can be hard to get there, but at least on some of these metrics, like the critical ones that we have on the slide here, I totally agree with Lyle in that you should be preparing these on a monthly basis. Now, and the poll here too for some results on that was 33% of you said, hey, we're good. No issues. 50% said we'd probably be fine. But we know the areas that would need some work. And then roughly, 20% of you said it'd be a struggle to get everything together or it would be a nightmare. So I appreciate the honesty. I think even if you're pretty good at this stuff, due diligence, every person that I've ever heard going through due diligence says it is a struggle because it's so much in such a short period of time.
It's also, I think, a good time if you're not confident to ask for resources from your CEO. Like a fundraising and or an M&A event, there's really no more critical time in the company's life cycle, especially from a finance perspective. So getting it right will be worth millions of dollars, and it also might spell the difference between success and failure. And it's a time where the finance department's role is extremely elevated. So it's a good time to ask for resources if you need it.
Yeah, that's a great transition in here to tactical takeaway. So while we're, Todd already had the first tactical takeaway here on this webinar where it's, make sure that you're talking to your CFO CEO to get the resources that you need if you know you're about to go through this. Also, if anybody has, we'll also kind of open this up for Q&A. If Todd and I will round this out here over the next few minutes. But if you have any questions, go ahead, drop that into the chat. We're happy to take it, and then we'll wrap up here shortly. The other, kind of building off what Todd said, one of my, maybe a similar way to say that is just, ask for help. And if you're not able to do this on a monthly basis, or you have a lot of stuff to clean up, it's never too soon to clean that up. And so, if you're looking for help, whether that be like a fractional firm that can come in, or advisors, I know myself and or Todd would be happy to recommendations to anybody on this webinar. Like we were saying, the whatever cost you might pay today, which, if you do it early in your life cycle, the costs are generally negligible in the big scheme of things. Certainly a lot less than if you get to the due diligence round and you either don't even get an offer, or somebody tries to haircut the valuation of the company. Can guarantee you those costs are going to be far higher than the costs you would pay to clean up some of these financial foundations.
I think too, some of the consultants that can come in, advise, and leave, right? So you don't have this ongoing expense, are pretty good at knowing what tools are appropriate for you at your stage. So not getting them too early, but also not waiting too long. So, you can also, ideally you want them to be out of there within, 3 or 4 months and have a setup process that's, easy and repeatable.
Todd, any other tactical takeaways for this group?
No, none that I can think of. I mean, it is, look, a lot of what we talked about today is common sense, but it is, if you go through a fundraising process or M&A, is probably 3 times more intensive, I would say. I'm not sure that it should be, but it is. Then, I would put M&A and private equity in that 3 times more intensive, and venture less. But you need to get this stuff right, from the very beginning, and you don't get a second chance.
Yeah. Well, Todd, I appreciate your time. It's been fun chatting with you about.
Yeah, thanks for having me.
And hopefully for everybody who's been tuning in here, it's been helpful for you all as well. So if anything here resonated with you, feel free to hit up Todd or I through LinkedIn. We'd be happy to elaborate on any of these topics in any way that would be useful. So thanks everybody for the time, and we'll catch you next time.
Thanks, John.